Welcome to The Deep Dive, your essential briefing, where we extract the most important nuggets of knowledge from corporate earnings calls. Today, we're diving deep into Oxford Industries, Inc., ticker symbol OXM, and their second quarter of fiscal 2025 results.
Yeah, we're going to unpack their financial performance, look at the key brands, and management's outlook. And what's really fascinating here is how this call sparked such a strong market reaction, despite some pretty big macroeconomic headwinds. So our mission today is really to figure out what investors heard that they liked so much.
Absolutely. So let's kick things off with the headline numbers. Oxford Industries delivered a really impressive beat on adjusted earnings per share for Q2 FY25. They reported $1.26 per share. That significantly beat their own guidance and the street consensus, which was more like $1.18 to $1.21. So a clear win there.
Right. And this is where it gets interesting, because while total revenue came in at $403.1 million, that's actually down 4% year over year and a slight miss against consensus. Consensus was looking for maybe $406 to $411 million. But despite that miss, the market reaction was, exceptionally positive.
Yeah.
It wasn't just a shrug. It really felt like a clear vote of confidence in the company's strategy and resilience.
The vote of confidence, definitely. But I'm wondering, in this climate where so many retailers are finding it tough, does this positive reaction for Oxford maybe also reflect a kind of best-in-class feeling? Are investors rewarding their relative strength in a hard sector? Or was there something specific in the numbers or outlook?
That's a great question. I think it's probably a bit of both. There's definitely some relief in there. Expectations were pretty tempered given the environment. But more fundamentally, I think it shows investors are really valuing resilience, proactive management, and profitability over just, top-line growth at any cost right now.
Yeah.
And the story management told was strong. It sounded like they have a handle on the challenges.
Okay, that makes sense. So with that background, let's dig into those pivotal financials a bit more.
Okay, let's unpack the key numbers. Adjusted gross margin for the quarter landed at 61.7%. Now, that represents a 160 basis point contraction year over year, so 1.6 percentage points lower. A really big factor there was an estimated $9 million in incremental tariffs. That directly squeezed their margins by, increasing the cost of goods.
Right. But what's really interesting, though, is management pointed out something crucial. Without those tariffs, gross margins would have actually gone up, which really highlights how effective their mitigation efforts have been against this tough external pressure. But it does make you wonder, how sustainable are these mitigation tactics long term? And could they be masking underlying demand weakness that might pop up later?
That's a critical point, yeah. Their immediate moves, like pulling forward inventory, they've been impressive. But you can only do that for so long, right? Yeah. Long-term sustainability will really hinge on diversifying sourcing properly and maybe absorbing some cost rather than just passing everything to consumers, which could hurt demand. It's a tricky balance. Now, moving to expenses, selling, general, and administrative, or SG&A, those rose 5% to $224 million.
Okay.
This increase is mostly tied to strategic investments. They added, 26 net new retail locations and 3 Tommy Bahama Marlin bars since last year. Plus, there's ongoing work on their big new distribution center in Lyons, Georgia. That obviously takes significant capital now for future efficiency gains.
And speaking of capital and planning ahead, their balance sheet also shows some proactive moves related to these same challenges. Looking at the balance sheet, inventory was up 13% on a FIFO basis year over year. FIFO, for anyone maybe not familiar, just means first in, first out. An accounting thing, assuming the first goods bought are the first sold. And this increase, like you said, was largely proactive. They accelerated purchases to try and minimize the hit from potential tariff hikes. Plus, there's $5 million in capitalized tariff costs baked in there. So is this a smart risk? Or does carrying all that extra inventory open them up to other problems?
It's definitely a trade-off, you're right. Pulling inventory forward hedges against future tariff hikes, sure. But it also ties up cash, increases warehousing costs, and carries risk if demand softens or, trends change suddenly. Obsolescence is a factor. However, given their history of pretty good inventory management and the specific rising nature of these tariffs, management's clearly betting the cost of not having the inventory or paying higher tariffs later would be worse. They're managing the risk, not eliminating it.
Got it.
The company also reported $81 million in borrowings. That's a notable shift from having zero borrowings last year at this time. This reflects capital going towards those growth investments, the DC, the stores, and also share repurchases. So an active capital allocation strategy.
And shareholder returns.
Yep. A dividend of 69 cents per share was also announced, payable in October.
Okay. So Beyond the big picture numbers, the individual brand stories are often where you see the real texture. What stood out to you, positive or negative, looking at Lilly Pulitzer, Tommy Bahama, and the others?
Yeah, that's where you really see the portfolio diversification playing out. Lilly Pulitzer, for instance, just kept up its strong momentum. Positive direct-to-consumer comparable sales. It almost feels like Lilly operates in its own little world sometimes, doesn't it? Especially compared to broader retail woes.
It really does.
Innovation in their casual stuff, like a Linen Sea spray jacket, apparently sold out fast. And they did this Lily's Vintage Vault thing with an old archival print that exceeded expectations. It brought in loyal fans and new customers, too. Shows the brand's unique pull.
Definitely a strong performance there. So Lily's shining. What about Tommy Bahama? That's often a key indicator for their more established brands. You mentioned it underperformed. What were the specific problems and what are they doing about it?
Yeah, Tommy Bahama didn't quite hit internal goals in Q2. Sales were down 6.6%. Main issues they called out were pretty specific. Color assortment and just the completeness of the line in spring and early summer deliveries. This particularly hit sales in Florida, which is obviously a huge market for them. So it sounds more like a product mix issue than a fundamental demand problem.
Okay, but management sounded pretty upbeat, saying they're energized by the work underway. And they actually saw better results out west where the assortment seemed to land better. Critically, early Q3 trends show significant improvement. Comps are around flattish now, and apparently their new Boracay Island chino pant, even at a higher price point, has been a big hit. That suggests product innovation can still drive things, even with a premium price.
Absolutely. It really underscores how crucial getting the product mix right is, and also their ability to react quickly. Getting the right colors, the right items for the season. It can make or break performance. It looks like they're correcting course pretty fast. Johnny was, though, unfortunately, continued to face headwinds. Sales down 9.7%. That indicates ongoing struggles for that brand. But they say they're implementing a comprehensive plan, enhancing merchandising, marketing, customer segmentation, trying to turn it around.
That's a tough spot. What do you think about the potential for that turnaround plan? Is it a long haul, or could we see quicker results maybe?
Well, turnarounds, especially in fashion, they're rarely super quick. But management being open about the issues and having a detailed plan is a good sign, right? Fixing merchandising, marketing, segmentation, those are the right levers to pull. Execution is everything, though. It suggests they're not just waiting for the market to get better, they're actively trying to re-engineer the brand's approach. Meanwhile, the emerging brands group that's a Southern Tide, the Buford Bonnet Company, Duckhead, and Jack Rogers, they delivered solid revenue growth. Up 17.0%.
Wow, 17%.
Yeah, driven by new stores and positive comps. It reinforces their growth potential within the overall portfolio. This segment really shows the value of Oxford's diversified strategy.
That's definitely a bright spot amid some of the other challenges. Good to see growth engines still running strong. Now let's talk about the elephant in the room that hit their margins. Tariffs. How are they navigating that whole complex situation?
They're tackling it from multiple angles. Sourcing diversification, pulling forward that inventory we talked about, some calibrated price increases, and also getting concessions from vendors. While the potential gross tariff hit for fiscal 25 was initially pegged as high as $80 million, they've already managed to mitigate roughly half of that through these moves. This proactive stance is a big reason for that positive market reaction we started with.
So that means the net after-tax impact on earnings is now projected to be somewhere around $25 million to $35 million, or about 1.25 to 1.75 per share. I mean, considering that initial shock number of $80 million gross exposure, that feels remarkably contained. It really speaks volumes about how effective their mitigation has been. They weathered a storm that could have been much worse.
Exactly. And for the full fiscal year 2025, Oxford Industries actually reaffirmed its guidance. They're projecting net sales between $1.475 billion and $1.515 billion. It's a slight dip year over year, mind you, but adjusted EPS guidance remains between $2.80 and $3.20.
Okay, reaffirming guidance despite those ongoing tariff pressures and, let's face it, a tricky macro environment. That sends a pretty strong signal, doesn't it? Management feels confident. But even with that confidence, are there still areas where the full-year outlook might face some pressure?
Oh, absolutely. They do expect gross margin to contract by about 200 basis points for the full year. That's mainly due to those tariffs still, plus ongoing promotional activity across the retail sector. And SG&A is projected to grow mid-single digits, reflecting those strategic investments, the DC, new stores. So while they're confident in the bottom line number, it's not coming without some squeeze on the profitability metrics along the way.
Right.
Non-operating items will also play a role in EPS. Interest expense is expected to jump to $7 million, up from just $2 million in FY24. And they're forecasting a higher adjusted effective tax rate, too, around 26-27% compared to 20.9% last year. Each of those hits EPS by roughly $0.20 to 25 cents per share. That's not insignificant when you look at the full year picture.
So even while they're managing the core business well, these kind of external financial factors are still taking a bite out of potential earnings. What about the very next quarter, Q3?
For Q3, they anticipate sales between $295 million and $310 million. And they expect an adjusted EPS loss of between 1/5 and 0.85 cents per share. Now, they were careful to point out this is seasonal for Q3, which is typically their smallest quarter. So important not to overreact to a seasonal loss figure.
Understood. But crucially, Q3 to date total company comparable sales are actually modestly positive, low single-digit range. And what seems particularly encouraging is Tommy Bahama showing that big improvement, nearly flat comps now compared to the negative trends before. That really suggests the product and marketing fixes are gaining traction, like you said. Do we know what's driving that improvement specifically? Is it just better product, or are more people coming in?
Management specifically said that Tommy Bahama's improvement is primarily traffic-driven. That's a really positive sign.
Yeah.
It means customers are responding to the changes. They're coming back into the stores, engaging with the brand again. Suggests the product tweaks and marketing are working to draw people back.
Good to hear.
On the investment side, capital expenditures for FY25 are expected around $121 million. That's mostly for the big Lyons, Georgia distribution center and new store openings. This higher spending level is projected to moderate significantly in FY26 and beyond, settling around maybe $75 million annually once that DC project is wrapped up. So it indicates a strategic but temporary investment phase to boost long-term efficiency and reach.
And besides the DC, they plan to open about 15 net new full-price stores by year-end, including 3 more Marlin bars. So still focused on retail expansion, even while managing costs carefully.
So putting it all together, what does this mean for you as an investor? Oxford Industries is showing, well, pretty remarkable resilience against some major headwinds, tariffs, a promotional retail scene. Their proactive steps shifting supply chains, pulling inventory forward, careful pricing. They're clearly softening what could have been a much bigger financial blow.
Right, that strong adjusted EPS beat, combined with reaffirming the full-year outlook despite all these challenges, that definitely sent a powerful positive message to the market. Led to a big re-rating of the stock. Shows investors are really buying into their strategy and execution right now, maybe seeing them as a best-of-breed operator in a tough space.
Yeah, and the mixed brand performance, strong Lilly Pulitzer and emerging brands versus the struggles at Tommy Bahama and Johnny Barton, it really highlights why that diversified portfolio matters.
What's interesting, too, is how open management was about the underperformance and the specific plans they have. That kind of transparency is key for investor confidence, I think. It reduces uncertainty.
And those positive Q3 to date comps are such a critical early sign that the fixes are working, especially for Tommy Bahama. And the fact that it's traffic driven, that's a good indicator. Consumers are responding directly to the changes, not just, deep discounts. Exactly. And the increased CapEx, while it hits short-term debt and SG&A, it's clearly part of a long-term plan for efficiency and market reach. Committing to infrastructure, strategic store growth, with that spending set to moderate after FY26, it shows discipline. But it does raise that key question. How effectively will these big long-term investments translate into sustained earnings growth down the line? And, if you're an investor trying to play these unique aspects, how might you approach it?
Which brings us perfectly to our wild yet plausible trade idea segment, where we look at Oxford Industries from maybe a slightly different angle.
Okay, so given Oxford's proven ability to handle these tariff impacts and those early green shoots of recovery at Tommy Bahama, maybe you consider a long position in OXM, standard enough.
Right, but now for the twist. Layer on a short position against, say, a pure play high-end apparel retailer that has significant exposure to unhedged Chinese sourcing. Think about a brand that maybe hasn't diversified its supply chain quite as aggressively as Oxford has.
Yeah, the thesis here is that OXM, with its diverse sourcing, its proactive inventory moves, its proven knack for navigating tariffs, it's kind of a tariff-resilient play. This could create a natural hedge against broader industry weakness that might be driven by ongoing trade issues. It's really a bet on superior operational strategy.
So if Tommy Bahama's holiday refresh really connects and Lilly Pulitzer keeps doing its thing, OXM could have some serious upside, especially as those big investments start to pay off. Meanwhile, your hypothetical unhedged competitor might be struggling with margin compression, maybe inventory problems because of tariffs. You're essentially betting that Oxford's strategic supply chain work will let them outperform the less adaptable players in apparel. Okay, so to recap, Oxford Industries delivered a strong adjusted EPS beat for Q2 FY25, showed impressive resilience against tariffs and a tough retail backdrop. Revenue saw a slight miss, but strategic mitigation efforts plus strong performance from Lilly Pulitzer and the emerging brands are driving positive momentum.
Yep. They reaffirmed their full-year guidance and, really importantly, reported those positive Q3-to-date comps, signaling a potential turnaround for some key segments like Tommy Bahama. It paints a pretty compelling picture of a company navigating a really complex retail world quite successfully, at least so far.
And as always, this discussion is purely for informational purposes. It should definitely not be taken as financial advice. We strongly encourage all our listeners to do their own homework.
So what stands out to you from this Oxford Industries call? Are there tariff strategies, something other companies could copy, or do you see unique risks maybe in that inventory buildup? What aspects are you going to be watching most closely in the next few quarters?
Feel free to send us your thoughts and questions. Until next time, keep those tickers talking.